Hello, this is our third lesson for chapter 1. Prepare financial statements. How do you prepare financial statements? Financial statements are business documents that are used to communicate information for decision making. It's mainly for the external use. Okay, so we're gonna start with the first one, which is income statement. The income statement reports the net income or net loss of the business for a specific period. The income statement, also called the statement of earnings, presents a summary of a business entity's revenues and expenses for a period of time, such as a month, quarter, or a year. Then the second statement is called statement of owner's equity. The statement of owner's equity shows the changes in capital for a business entity during a time period, such as a month, quarter, or year. The third statement is balance sheet. The balance sheet reports the business entity's economic resources, assets, the amount of debt owed to creditors, liabilities, and the net worth of the entity, equity. The balance sheet shows the financial position of the company at a certain date, not for a period like the previous statements. The fourth financial statement is called statement of cash flows. The statement of cash flows reports the cash coming in, positive amounts, and the cash going out, negative amounts, during a period of time. Now, the first statement is the income statement, which reports the net income or net loss of the business for a specific period, such as a month, quarter, or year. The income statement tells whether the business generated net income or suffered a net loss. Remember, net income means total revenues are greater than total expenses. And net loss means total expenses are greater than total revenues. It's important to remember that only two types of accounts that are reported on the income statement are revenues and expenses. The second statement is statement of owner's equity. The statement of owner's equity reports how the owner's capital account balance changed from the beginning to the end of the period. So my formula will be beginning capital plus owner contribution plus net income or net loss less withdrawals equals ending capital. Notice that the net income for the month is the net income that was calculated on the income statement. This is the main reason why the income statement is prepared before the statement of owner's equity. The net income must first be calculated on the income statement and then carried to the statement of owner's equity. Now, what's the difference between beginning capital and owner contribution? Beginning capital is the capital that you start with at the beginning of the period, which you already have from the previous period, while owner contribution is any investment or contribution was made during this period, during this month, for example. The third statement is the balance sheet. The balance sheet reports on the assets, liabilities, and owner's equity of the business as of a specific date. It's not for a period of time like the previous statements. So at the end, your total assets should equal your liabilities plus equity. The balance sheet is a snapshot of the entity. An investor or creditor can quickly assess the overall health of a business by viewing the balance sheet. So in the balance sheet, we're gonna list down all of the assets accounts and liabilities accounts, while for the equity, we're gonna take only the ending capital from the statement of owner's equity. The fourth statement is the cash flow statement. Now, the statement of cash flows reports the change in cash during the period. It only reports transactions that involve cash because it reports the net increase or decrease in cash during the period and the ending cash balance. The ending cash balance on the statement of cash flows is the same as the ending cash reported on the balance sheet. The statement of cash flows is divided into three sections: operating, investing, and financing. Operating activities involve cash receipts for services and cash payments for expenses. Investing activities include the purchase and sale of land and equipment for cash. The third section, financing activities, includes cash contributions by the owner and withdrawals of cash by the owner. Thank you for watching. If you have any question, please leave a comment. Please like, share, and subscribe.